Alright, what's up guys, it's Gaddy Trades here. I'm back with a video explaining measured moves and standard deviation projections and how I use them in my trading model and how I'd recommend anyone use them in their trading model. Now before I get started, I'm going to simply introduce myself to those who do not know me. I am a day trader who's live streamed on YouTube every single day, basically showcasing my entire journey as an ICT trader. I primarily trade futures in the day trade aspect of trading, so usually 9:30 to 11 are where I'm taking most of my trades, sometimes in the PM session, but that's kind of where my edge is, right? So without further ado, I don't want to waste anyone's time. Let's get into the video and talk about what we're going to be talking about. Okay, so we're going to be talking about measured moves and standard deviations projections. Before anyone said this is hindsight, I literally live stream every single day on YouTube. If you want to check out everything I call out live, it's all there for you for free. Now, measured moves and standard deviations are a way to project a potential expansion move to see how far mathematically price can expand, all right? Let me explain. Standard deviations is a tool that we use to measure the potential move that we already expect coming, right? Now, just like anything else, this requires narrative and a drawn liquidity. So the measurement itself is useless if you do not know what you are measuring or measuring the wrong thing. So I'm gonna give you guys a quick analogy. Let's say you need a measurement for a piece of wood, and then you go out and you're measuring a piece of gum or something, right? You're not measuring the right thing. You're not measuring, you do not know what you're measuring. You don't know what you're doing. So you need to have narrative and drawn liquidity for every single, right, projection here that we're gonna be talking about. Now this isn't a foolproof way to determine every single price expansion. This is simply a tool we use to measure the potential move that we already anticipate is coming, all right? Now, before I get into the examples, I'm gonna give you guys this little simple note, just to quickly give you a little simple demonstration of what exactly standard deviations is. So these are the settings for the Fibonacci retracements. 1, 0, negative 1, 2, 3, 4. You can keep going 5, 6, 7. Those are really large expansions. They don't typically happen that often on a regular day. So I don't include those in my Fibonacci settings. So these are the main ones that I use. Now I already went over my Fibonacci retracement settings. So you can see we anchored this from low to high of this anticipated price move. So we have a higher time frame PD rate acting as resistance. We're expecting lower prices. We see a manipulation leg into that level. So this move from here to here, right, we're expecting to be delivered to the downside. I'll explain more in the examples, but this is a visual representation of what you're expecting. So you're expecting this move from here and here to be at least delivered towards the downside, and this is how far it can potentially expand. So this move can either double, so it can like form once, it can form twice, 3 times, and 4 times this original leg. So that's what you're kind of looking for with this kind of idea. So going into the examples, you'll see exactly what I mean. So this is from, I believe, Monday, August 26th. I don't remember if I actually took this trade, but this is something we talked about during the live stream itself. So you can see we have accumulation right here, right? This is an accumulation pre-market. And you can see right here, we ended up taking out this buy side liquidity, right? So what is the narrative and context here? Like I said, that you need to have to be able to project a move like this. So you have this accumulation over here, pre-market. This is 9:30 open. What do? We all know the 9:30 infamous Judas swing, where we see a price rally in one direction, taking out the buy side. You know what's most likely to come is this is a manipulation, and then you expect a distribution to the downside. So you can see how we're building a narrative after taking the buy side, manipulating from this accumulation, right? We have these relative equal lows right here, and if you look at the higher time frame, there's more down there, but for now let's focus on this price fractal. You can see that we manipulated up. Now that we've had this range of manipulation from high to low, I'm going to explain to you guys exactly what a standard deviation is. So from this low to this high, we anchor our standard deviations tool. So coming into this price action, we have the narrative and context built, right? And we're expecting, potentially anticipating a move to the downside. How far can we expect this move to come? So, and like I said, we marked out these levels, the 4-hour low and the previous day low. So this is not hindsight. Like I said, we talked about this in the live stream, which is why I'm choosing this specific example. So we have the buy side rate, the accumulation, the manipulation. So this would be your manipulation right here. And we could just box that in red. And you're expecting a distribution to the downside. So what exactly is a standard deviation projection and measured move? So this move from low to high is your manipulation leg, right? So we manipulated from this low to this high. We expanded in this direction. Now, if we're going to expect a distribution in the opposite direction, we can take this move, which from this low to high, we can measure it as 58 points. So what is going to be resting over here from this range? You would expect at least a 58 point move. So this range from 0 to 1 is equal to 0 to -1. So you're expecting a measured move, right, in the opposite direction, at least -1 standard deviation. And that's where I like to take my profit, like ideally aiming for a low-hanging fruit over there. Some people do use a -0.5. You can kind of just eyeball it for the 0.5s. But you basically want to be targeting levels that overlap with this. So allow me to continue my explanation. So you're expecting a measured move from this manipulation leg lower. So that's the -1 standard deviation. Now you can continue this expecting a move into -2, -2.5, and -4 is usually where you see your max expansions. Now it can go more, right? You can multiply this move by 5 and you'd have 1, 2, 3, 4, and then you'd have your fifth one, right? So that is something you can definitely do. However, I personally do not look for moves that expand more than that. I mean, you're always keeping an eye out, but you don't want to expect too much expansion because you might be aiming for something a little too high. Now, obviously, if you're swing trading, it's a different story. We're talking in the frame of this specific trade, right? So what happens here? We have the measured move. Now, we called this out live, and with the power of, right, market replay, you can see we ended up expanding towards -1 standard deviation. So that's this move doubled, this move tripled. So this move right here is single move, doubled, and then you're looking for tripled and potentially 4. Now, the best way to use standard deviation projection is to overlap them with already objectives. So what I mean by that is this 4-hour swing low and previous day low, notice where they are located, right? So when you pair this with time, right, we have this 10 a.m. open high low close idea and the 9:30 Judas swing and AMD setup kind of forming here. You can use that idea of time relative to these key levels and the standard deviation to see where price can expand. And obviously we end up taking previous day low, which just so happens to line up with the -4 standard deviations really nicely, right? So we managed to manipulate this move. So this manipulation leg, right, was multiplied 4 times towards the downside. So it gave us a maximal expansion, you could say. Now, obviously this can keep going -5, -6. You don't know, right? It can keep going, but see how this level overlaps with the -4, -3. So we ended up getting right there in between -3.5 standard deviations. So 3 moves and a half of this. So like I said, this was 50 moves. So every time it goes from here to here, that's another 50 points. So that's how you can use your standard deviation projections with narrative, context, and your targets, right? Now, some people, they like to have a strict rule. For example, they will take a partial every time at half standard deviations. I'm not a fan of that. I don't think that really makes sense. I kind of already have my drawn liquidity and see where can price potentially go to. So I kind of use it that way. But for some people, they want to maybe take a partial at -1. Some people, they aim for -2 between -3. So basically this move doubled. It's really up to you and your model. You need to know where you normally take profits, where you normally put your stop loss, how big of moves you're normally trading. But for me, I simply look to align my already drawn liquidity with this just to add a secondary confluence for the trade. So let's go into another example. Okay, so here's another example. This is simply the very next day. Now, obviously this market repeats. You can see that in this photo. What do we have here? Accumulation pre-market, 9 a.m. candle open. We've been accumulating around it. 9:30 comes in, the volatility injects. Where do we go first? Down. This is your manipulation leg. Now, if you were bullish, where could we potentially be bullish to? See these equal highs, right? These highs over here, these relative equal highs over here, right? Now, if you go to the 5-minute, this still applies. You see the 5-minute accumulation, manipulation, distribution towards these relative equal highs. But in this case, we'll stay on the 1-minute. I pretty much always trade on the 1-minute. So this is what I saw live. So 9:30, exact same scenario as last time. You already know what's going to come. So this move is 96 points. We can expect at least 96 points in the upside from this high. What ends up happening? We expand. And I'm not going to talk about the actual entries. And you can see we have a little retracement at 10 a.m. So 10 a.m. accumulation, open, low, high, close. And we end up taking the London highs that are resting just above -1 standard deviation. So this move doubled right here. So this move right here is basically the same space in this move, which happens to line up really nicely with the -1 standard deviations. Now, most of my TPs, if there's a large manipulation like this, I'll look to TP around -1 to -1.5. That typically looks where I'm taking my first partial, I would say on an average. If it's a smaller manipulation, like for example, let's say the manipulation leg was like this, right, it would be around -2, -2.5, or even -4. Now, depending on the manipulation leg you want, the manipulation leg that you have, you can see potentially how far price can expand. But like I said, I always look to align them with obvious strong liquidity. So going into the marketplace, I was already bullish. I already saw these London highs as a potential draw on liquidity. After I saw this manipulation leg taking out the sell side and the 930 Judas swing playing out really nicely, I mark my standard deviations from high to low, and the negative standard deviations being -1 and -2 in between there. I'm noticing that this is where it lines up. That's where I want to take my first partial. And that's just how I trade. Now you need to implement this in your model. I'm just going to teach you guys how I use it in my model, right? All right, now if you have any questions, feel free to ask me in the comments below. I do have a Discord with over 10,000 people, I believe, and we're very helpful there. Everything's free. You'll never see me ask you for any money. This is Getty Trade signing out. Till next time, peace.